I think it's safe to say at the beginning of 2021, nobody would have expected to be sitting here in November of 2021 discussing a stock market that is up over 20% for the year. Now, nobody needs to look further than December of 2018 to see that the markets can turn the other direction very quickly. But when the market has a better than anticipated year, we want to look at two different things to consider in that environment. I often joke with my clients that my crystal ball is out for repair, and unfortunately it's been out for repair for a while, and it probably would have come in handy this year, though I'm not sure even it would have anticipated the kind of year that we're having. At the beginning of 2021, the pandemic was still ongoing. In fact, it's still ongoing today. Throughout the year, we've heard different talk around changing tax legislation as well as other pieces of legislation. And there are still parts of this economy that haven't really recovered from the pandemic. So many people are surprised to see the markets where it's at. And so this first idea that we're going to talk about, which is don't panic, highlights that point a little bit.
Before we really start talking about what's on this slide, I do want to reiterate, though, that while we want to avoid panic buying when the market's high, I'm not saying we shouldn't necessarily buy at different points in the market even when it's high, depending on your time frame for investing, when you're going to need the money. It could still make sense to invest at different points of the market, including when it's high. But what we want to avoid is this idea of panic buying, where we're afraid of missing out on something, that old adage of FOMO. And so we just dump money into the market at a time when maybe it's not the best for you based upon your situation. And so if you look at this chart here, the bottom one is what I'm going to focus on, and it says 20-year annualized returns for different areas of the market from 2001 to 2020. And what you'll notice is the average annualized returns for the S&P 500, or what many people would call the stock market, is 7.5%. Now that takes into consideration the fact that we had the tech bubble in the early 2000s, we had the housing crisis in 2009, 2010. But if you just bought at the beginning of 2001 and held it through the end of 2020, you would have averaged 7.5% per year in the S&P 500. And you can see various other asset classes here, including a 60-40 portfolio. So this would be 60% stock, 40% bonds. During that time period would have averaged 6.4%. But I want to highlight this one right here. And this column, or this bar, shows the average investor during that same time frame averaged 2.9%. And typically that's because most investors tend to get caught up in the emotions of the market, and they will buy at a high and sell at a low, which is exactly the opposite of what we want to try and do. So that's where the panic buying comes in, is that oftentimes people feel like they're missing out on something. They want to buy into the market, and then they panic on the opposite side of that, and they sell out at the worst possible times. And so that's how you end up with an average here of 2.9%.
The second point I want to reiterate is actually something we've talked about before. I've written a more in-depth piece about it. We'll put a link to that in the description below. But it's this idea that we need to make sure that we are rebalancing the portfolio. And especially in a year when the market's done better than anticipated, sometimes it's a little easy to get lackadaisical with the portfolio and not stay disciplined with it. So we're going to take a look at what rebalancing does to a portfolio and the effect it has on the long-term performance of your portfolio.
So one of the benefits of working with Stewardship Advisors is this idea of rebalancing is something that we do automatically for our clients. So anybody that we manage money for, we do quarterly rebalancing to the portfolio. So we just take care of that for you. So looking at this slide here, what you're going to see is this idea that if we start with a 60% stock and 40% bond portfolio, over time, depending how different pieces of the portfolio perform, that pie chart could look very different. And so right here you'll see in September of 2001, if we would have started with a 60% stock, 40% bond portfolio, by 2007, because of the market returns, it would have grown to 65% stock and 35% bonds if we had not rebalanced it at all. Forward to 2009 and the reverse happened, right? We had a big drawdown in the market during that time period. And so that 65% stock dropped to 54% stock. And by September of 2021, that 54% would have grown to 80% stock and 20% bonds. And what this does is, for somebody who wanted to be 60% stock and was comfortable with that level, if you didn't go in from time to time and rebalance the portfolio or sell off the things that did well and buy the things that are underperforming to get you back to that initial starting allocation, you're going to end up with a lot more risk than what you feel comfortable with. And so the next time the market corrects, you're now going to potentially experience a bigger drawdown because you're starting with a much higher risk level. So rebalancing the portfolio is not necessarily about maximizing returns, as we'll see on this side of the chart. So this particular chart, the shaded bar here, the darker one, shows that over a 20-year period, again, a 60-40 portfolio, if you annually rebalanced it, that means at the beginning of each year, you went in, and if it was 65% stock, you sold 5% to bring it to 60, you would have averaged a 7.8% return over that same time frame of 20 years. Now, if you just bought 60-40 in 2001 and never touched the portfolio, let it do its growth to 65 or back down to 54, you would have actually averaged a slightly higher rate of return of 7.9%. The real difference comes in what's known as the standard deviation, which is what they refer to as generally as the risk of the portfolio. So the larger the standard deviation, the larger the swings you're going to experience in the portfolio. So for a portfolio that was rebalanced annually, that standard deviation was 8.5% versus one that was never rebalanced, the standard deviation was a little over 9%. So you're picking up just a slightly better rate of return by about 0.1%, but you're increasing the risk by almost 0.5%. And so most people wouldn't feel comfortable with that kind of a risk-reward trade-off, just because the portfolio is going to swing higher and lower, and it could be swinging at a time for you that you need to draw money from it, but we have now drawn down a little bit harder than anticipated. So rebalancing really helps with this idea of keeping it to the appropriate risk based upon your situation and when you're going to need the money in the future.
These are just two of the ideas that we're talking about with clients this year, as the market's had a pretty good return so far. So if you have any questions about this information, would like to discuss how it relates to your situation, please don't hesitate to reach out via phone or email. We'd be happy to discuss it with you further.